Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler talking money and investing. Now, we got some really good advice this week from a technical analyst. Now, I'm not big on technical analysis. Matter of fact, when I was talking about looking at fine print earlier, that is one of those things I look for. If I'm reading an ADV, that is a document that's a disclosure document. I'm looking for things like fundamental analysis. Are they engaging in fundamental analysis? I've read a lot of ADVs recently of investment firms, and that is typically, you'll see that all the time. It means that they'll go in and they'll study the company, study the balance sheet, determine which companies are better than others. Well, that's why I always loved about John Stossel throwing darts at the stock tables, because he'd beat these people that did that kind of thing. The other thing you're going to see is technical analysis. We're looking at, you'll see charting. They'll look at the charts of the company and determine which ones. So, anytime a technical analyst is on there talking about markets and investing and what you ought to do next, I kind of, it's a little grain of salt, right? That's kind of the way I look at it. But I thought this was really kind of funny. This technical analyst is talking about what you ought to be doing with your money right now. And here's what she had to say.
I think for investors, the most important thing is to have a diversified portfolio. It was okay to have a concentrated portfolio when the Mag 7 was doing well, but...
Okay, belabor the obvious. It's okay when companies are, that they're outperforming and they're doing well, a small group of companies. It's okay to be not diversified then, but after they've crashed, now you got to diversify. It's probably a really good idea to make sure you diversify. It's too late after they've gone down in value. Now, number one, we're looking at after, like last year, you had international small value. Now, this is being talked about this week. Well, last year, international small value stocks shot up 52%. Small value U.S. stocks have outpaced everything else so far this year. Now that that's happened, now we need to talk about diversification.
This is not a Mag 7 market. You have breakouts.
It's not.
No, it's not a Mag 7 market.
That's a big statement, Marianne. This is not a Mag 7 market.
No, because you even have breakouts in small cap, right? And we haven't even talked about international markets. Major secular shifts now in the international markets. I don't think there's been a time in my career where you were in a secular bull market in the United States and outside of the United States. Yeah. And this includes emerging markets. So the
all-time high this morning again for the, what was it, the EEM or something? So this you think has legs?
Has significant legs. When I say secular bull market, very long legs, 10, 15 years.
Wow, 10 to 15.
Yeah, 15. You're going to make a prediction 10 to 15 years in the future? Yeah, forget that. How could you possibly know? You don't know what the next election cycle is going to bring. You have no clue what is going to happen. You have no idea what's going to happen as far as tariffs go or trade goes or costs go or inflation or technology changes, and you make a prediction 10 to 15 years in the future? That's crazy sauce. But that's the media for you. Go find somebody that'll say something insane. But here's the problem, is that people act on this type of stuff. Mutual fund companies act on this kind of stuff. Like I said, go look at a prospectus. Go look at an ADV. You will see that companies engage in technical analysis all the time and fundamental analysis all the time. But now you know what it is. It's basically looking into a crystal ball and trying to figure out what's going to happen next. And as I often tell people, you do not have to do that to be a successful investor. Matter of fact, when you do that, you actually hurt your odds of being a successful investor. It tends to increase risk. It tends to hurt returns. It tends to increase costs. And that's what Wall Street loves, because the reality of it, that's how they make money. They make money, a lot of it through trading. Now, another thing that happens is this. Fund companies will engage in this behavior because if they can get lucky, this is the key. This is really important. If they call it right and they get lucky, They will be paraded in front of you endlessly on TV shows. You'll have rating services rating them highly. Investment advisors will be recommending them because they typically, and I say typically, I rarely see somebody that does not do this, is not pulled in because instinctively it feels so good to move toward pleasure, but they're pulled in by past performance and recommend things after they've done well, and after they've done poorly, they ditch out. And often what I'll do with people is I'll say, go look at your statements. Give me several years of statements, of your investment statements. Bring them in. And what I want to see is how often funds have changed. And I'm going to tell you, it's almost a proverb, pretty much is one, that they will get rid of something after it's done poorly. Pensions, there have been studies on pensions, did this all the time. They'll get rid of something after it's done poorly. They'll buy into something, after it's done well. And then all of a sudden they'll say, hey, look, I've got you in the best mutual fund. At the end of the quarter, fund companies do this all the time. It's called window dressing. They will add the stocks that happen to have done well in the previous quarter just to show that they own them. They want you to see how brilliant they are. Because if you look at the end of the quarter and go, hey, what companies did really well? Oh, that company, oh man, I've been hearing all kinds of things about that stock. That company did well. Do I own that in my portfolio? And you'll go look and go, oh yeah, I do own it at the end of the quarter because, be there. But you didn't own it a lot of times when it did well, but you own it. So that's one thing. Another thing that drives me crazy about advertising is I love this. I see this all the time. You see these ads where you'll have these little books that they give away. You need this little book. We're gonna do this investigative little book for you, and we're gonna send you this book. Just for the asking. But check this out. Here's one of them.
Are you over the age of 50 and considering buying an annuity in the next 60 days?
Yeah, so a lot of people hear a lot about annuities. Me, people always ask me, Paul, you don't really seem to like annuities a whole lot. I don't, because the commissions are just outrageously high. Now, there are non-commission-based annuities, but you rarely ever see them marketed. In fact, most people don't even realize that they're out there. But they're used as accumulation vehicles, even though I can't think of a time that I've ever recommended, except for really early in my career. I recommended one time that I actually sold one. Thankfully, it was only one time. But I am not a big fan because of the level of expenses, what they're invested in, insurance companies, the misleading nature of the marketing regarding these things. But a lot of people, they go to their bank and that's the first thing that's recommended to them. Oh, you ought to have some of your money in annuity. And I'm just like, no. People ask me about it. I'm like, no, I'm not going to do that. We're not going to go there. But anyway, let me continue with this commercial.
Are you considering buying an annuity in the next 60 days? I have some important news for you. Don't buy an annuity until you understand the pros.
Should have just stopped at don't buy one. But anyway, sorry.
Until you understand the pros and cons of annuities. Call now for this free book on maximizing your income in retirement. Annuity Do's and Don'ts for Baby Boomers from one of the nation's leading financial firms. That's right, for
So it's annuity do's and don'ts, the things that you need. And I am all for you being an informed investor. I talk about that all the time. Who is putting this forward? Who is actually putting this book together? Let me play that again.
Annuity Do's and Don'ts for Baby Boomers from one of the nation's leading financial firms. That's
Now, what firm is this? It's an insurance company. Yeah, so it would be like going to a dealership. And I don't care what dealership you're talking about. I'm going to go to a Nissan dealership. I'm going to go to a Ford dealership. I'm going to go to Dodge. I'm going to go wherever. And expecting them to give me just totally objective information on their vehicles. We're going to tell you the do's and don'ts and all the pros and cons. It's like the person that goes to get the interview, right? They go to the interview and, the person in the interview asks, what's your greatest weakness? Oh, my greatest weakness, I just work too hard. I just, I spend long hours. I am just really, really detail oriented. And, they give you all their strengths, but they act like it's a weakness, right? Not exactly.
Free. This book reveals little-known truths about annuities in simple-to-understand terms. Grab a pen right now.
Yeah, grab a pen right now and get this book about the do's and don'ts and all the good stuff and the stuff that you really need to avoid, from the company selling the thing that they're talking about. Nothing could be less objective. It just boggles the mind that this kind of stuff is out there. But, that's kind of the way the world works, right? Really, really frustrating. Now, there was a little bit of treasury talk, this week too. The stock market, treasuries, what the Dow's been doing, inflation, economic activity. What I want to do is I want to take a quick break, and I'm going to be right back after this. I want to talk a little bit about just the markets and some of the things going on economically out there. There's a really interesting little clip that I want to share with you. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, Paul Winkler talking money and investing. So I'm often talking about, some of the things that go a little bit south as far as I'm concerned regarding the investing industry. And one of the things that really frustrates me is what younger people are being taught about investing and how they're being taught about investing. I saw this thing on the Wall Street Journal. It was a video. I'll share a little bit with you because it was pretty eye-opening. Check this out. If I can, let's see.
Traders chasing risky bets. I've been following his company for a year, and I've interviewed him multiple times. He's on a mission to capture the youngest generation of investors by making the markets feel fun and exciting.
Now, he's talking about Robinhood right here, so I just want to make sure that you know what she's talking about from this lady from the Wall Street Journal.
Almost like a sport. For example, Robinhood's earnings calls. They're modeled after NBA post-game interviews.
So basically, they're doing... These companies will talk about what their earnings are going to be, what's happening in the company, and they're making it look like something like a game, like an NBA post-game interview. So it gets people excited about it. And it was John Bogle had that line. He said they called it investainment. And, it's nothing new, but it's been bad for a long, long time. But they're bringing it to a new level here.
At a crypto event, he even starred in a spoof video of an old movie, To Catch a Thief, where he raced through the cliffs of the French Riviera in a convertible. But there's a bigger idea behind all of this. Tenev is catering to active traders, these people that are playing the markets almost every day. He sees them as key to the company's success, making it easier for ordinary people to...
So these people that are trading like this are key to the company, Robinhood's success. Now, we're not talking about the investor's success. We're talking about the company's success, because what happens, they're kind of like, they don't care. As long as you're playing the game, it's like, Steve Wynn Las Vegas was famously, once he quoted as saying, I don't care if you win, I just care that you keep playing. And that's the idea. They've got to keep you gambling with your money, because that's how they make money. It's the trades. That's really what's key.
Everything from stocks to more exotic products like meme coins or event contracts. That strategy has worked really well when markets are climbing. Robinhood's share price more than tripled.
Now, the point that they got a chart on here that you can't see, but when the stock market was going up and a lot of these high-flying companies were going up, the company's profits, Robinhood, is skyrocketing and the share price going up significantly. And that's the point she's making right there. But, let me just continue with what she says.
Robinhood's share price more than tripled last year, though 2026 has been a test of whether the stock can hold on to those gains.
And you see it going down pretty significantly in the chart. By the way, not all markets are down. There are a lot of markets that have done quite well so far this year. It just doesn't happen to be the types of companies that younger investors are even aware of. There are areas of the market that are up well over 10% the first month of the year. I mean, literally the first month of the year, 15% returns. And a lot of people don't even know about it because that's not what makes the news. That's not what these types of companies track.
Critics say that Robinhood can feel more like a casino, blurring the line between investing and gambling. You can now bet on sports, entertainment, or political events on Robinhood's app through something called prediction markets. And people still remember the GameStop trading chaos of 2021.
Robinhood restricted trading of 13 stocks, including GameStop.
But supporters credit the platform with making it easier for regular people to build wealth. Tenev's bet is simple. It's that younger...
Making it easier for regular people to build wealth through gambling? I suppose you can get wealthy gambling if you're really, really lucky. But how many people win the lottery? How many people win in the casinos? You ever been in a casino? It's just kind of sad. To me, so often what you see happening right there.
Investors want markets to feel entertaining, and they want access to every part of it, including the risky ones. And if the company can win over those traders, then Robinhood and Tenev can reshape Wall Street.
They want it to be entertaining. They want to reshape Wall Street. Thank you. No, I would rather see Wall Street be just a place where stocks are traded, where you have people that are making markets for companies. And don't make it a casino. That's been the problem all along. Is the way investment managers invest. Markets historically, the returns, without that type of activity going on, have done quite well. Look at the growth of capitalism around the world. You just want to be a participant in that. That's really what I always talk about. And then what happened this week? So let me just kind of finish this hour with what happened in the markets this week, because I thought it was just, I want to make some commentary here. Check this out.
2 year really screaming from.
So they're talking about 2-year treasuries right there. 2-year really screaming.
345 all the way up to 353. Why?
So what he's talking about there is the interest rate on 2-year treasuries, what interest rate the government is paying. So the interest rate has gone up. That's a pretty significant jump right there. Now, you think, what is it that you've always heard that Trump wants? He wants interest rates to come down, right? It's the other way. Well, what has happened, you hear that the Fed, lower interest rates, talking about lowering. Where do the interest rates actually change? In the markets. So the market itself actually, this interest rate changed with just buyers and sellers outside of the Federal Reserve, causing these interest rate changes to happen. So interest rates have gone up.
Because these are solid data points. And one more thing I'd like to point out, I am really on this kick. I think seasonal adjustments are dead on arrival on most numbers. Yesterday's retail sales looked flat. I brought it out at 8:30. But if you look at non-seasonally adjusted, it was the strongest December on record at $818 billion.
So there's basically a lot of good economic activity happening. And this idea that interest rates coming down, that used to be back in the late 90s, and this makes the stock market so hard to predict. Late 90s, if interest rates went up, stock markets came crumbling down. And it was vice versa. It was kind of this bad news, good news type of thing, right?
Kelly,
and I think Kelly actually says that here.
Back to you.
Everybody, Rick, thank you very much. And again, focus on the market reaction here. Futures are moving positive, even with that big move higher in Treasury yields that Rick was just discussing. Dow at open higher 200 points. This, guys, could become the day where we find out if good news is good news, or if we have to flip the script and say good news is bad news because Treasury yields are going up, Fed cuts are less likely, Mag 7 trade becomes a real focus.
There you go. So in essence, what happens a lot of times, if interest rates go up, it can be a struggle for stocks because a cost of doing business has gone up. But because of the economic activity, and again, this is why it makes stock markets so stinking hard to predict, you'll have a situation where the economic activity is good, but interest rates go up. And the reason being is that economic activity might necessitate the hiring of more people. When you have to hire more people, the cost of labor goes up. And in order to slow the economy down some, this is something that naturally happens. Interest rates go up, and that way it slows it down so you don't have too much growth too fast. And then the opposite happens when markets get a little bit soft. But this is why we own the right types of stocks and bonds together. Treasuries are a safer type of a bond. And when interest rates go up like that, bond prices go down, stock markets going up. That's what happens more often. And this is why I'm so adamant about owning the right types of bonds in an investment portfolio, especially as you get near retirement. Bonds are there for safety, and you want the right types of bonds that tend to go up when markets go down, or tend to go maybe go down a little bit or stay flat when markets are really, really doing well. And that was a really good case in point for bonds doing what we want them to do in an investment portfolio. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.